Welcome to The Explainer. Today, we're diving into Seanergy Maritime's incredibly dense, but honestly fascinating Q2 2026 earnings report. Now, if you've ever looked at a shipping company's financials, you know it can feel like staring at a giant wall of numbers. But my goal today is to translate all these heavy metrics into a clear, compelling story about corporate growth and strategy. So let's just jump right in.
We're kicking things off right at the top with a pretty massive financial win. Seanergy reported a record $26.2 million in net income for the second quarter. To put that into perspective, it's a colossal jump from just $2.9 million in the exact same period last year. I mean, that's the kind of bottom-line explosion that immediately makes you ask, how on earth did they pull this off? And more importantly, is it sustainable?
To figure out exactly how they achieved this, we'll follow a quick roadmap today. 1. Record Q2 financial results. 2. Consistent shareholder returns. 3. Strategic fleet expansion. 4. Financing and long-term charters. And 5. The Capesize market outlook.
Okay, Section 1. Record Q2 financial results. The headline numbers.
So looking at the top line, things are pretty clear. We're talking about a 59% year-over-year surge in net revenues, jumping from $37.5 million in Q2 2025 to $55.7 million in Q2 2026. And what you really need to take away here is that this revenue surge wasn't just empty volume. It flowed straight down to their profitability, driving a highly impressive adjusted EBITDA of $41.5 million for the quarter. Now, real quick before we go any further, we need to define a term you're going to hear a lot in this explainer: time charter equivalent, or TCE. Actually, the easiest way to think about it is taking a ship's net revenue, subtracting the expenses of the voyage, like fuel and port charges, and dividing all of that by the operating days. It basically strips away the noise and gives us the daily earning performance of a vessel. It is literally the fundamental pulse of any shipping company's true profitability. Armed with that definition, you can really appreciate the magnitude of this next number. Seanergy achieved a $32,355 daily fleet TCE in Q2. That's a staggering 63% increase over the roughly $19,800 they were earning daily the previous year. Think about it. When your fleet is pulling in over $32,000 every single day per ship, that operating leverage is exactly what builds that massive $26.2 million net income we just talked about.
Moving right along to Section 2. Consistent shareholder returns, rewarding the investors. Management is clearly keen on sharing this momentum because the board declared a 35-cent per share quarterly cash dividend. The crucial point here? This isn't just some one-off windfall for investors. This marks Seanergy's 19th consecutive distribution. They are consistently proving that when the company wins, the shareholders get a direct cut of those winnings.
Looking at the big picture, since they started this program, Seanergy has returned a massive $108.4 million to shareholders. And it's a really balanced approach. $63.2 million paid out directly in cash dividends and $45.2 million used for strategic repurchases of shares, warrants, and convertible notes. It just goes to show that management is deeply committed to a holistic approach, optimizing shareholder value from multiple angles.
All right, let's pivot to Section 3, Strategic Fleet Expansion, Building for the Future. Because they aren't just resting on their laurels here, they're locking in a staggering $591 million investment across 8 modern vessels. We're talking 4 scrubber-fitted new buildings coming in 2027, 3 more new buildings in 2028 and 2029, plus 1 modern 2022-built Capesize. By pairing scarce shipyard delivery slots with modern, fuel-efficient tech, they are perfectly timing their fleet renewal right ahead of expected market tightening. And, notice the specific type of ships they're buying. Seanergy is a pure-play Capesize and Newcastlemax owner. These are absolute behemoths, ships so large they literally cannot fit through the Panama or Suez canals. By focusing purely on this massive asset class, they maintain incredible operating leverage in the heavy raw materials trade, like iron ore and coal. They completely avoid the headaches and volatility of smaller vessel classes, which keeps their business model incredibly focused.
Which brings us to Section 4. Financing and long-term charters, de-risking the investment.
Because let's be real, buying massive ships requires massive capital. But instead of purely relying on standard bank loans with heavy, immediate repayment schedules, they got creative. They secured a €100 million unsecured corporate bond in Greece. It's got a 5-year bullet structure and a 4.90% coupon, which means no scheduled principal amortization before maturity. Why does that matter to us? Well, it provides long-term, non-dilutive capital perfectly matched to the construction phase of their new ships, preserving their liquidity right when they need it most.
And they didn't just stop at smart financing. They further de-risked the whole thing on the revenue side. For 3 of their 2027 new buildings, they've already secured multi-year charters. These contracts guarantee a floor rate of roughly $23,100 a day, easily covering their expected cash break-even. But they also kept the upside open. Through premium index linking, if market rates spike, their earnings spike too. They even have profit sharing that kicks in once rates pass about $29,750 a day. It's basically the ultimate heads we win, tails we don't lose scenario for these new assets.
Finally, let's look at the macro picture in Section 5, the Cape-size market outlook, macro tailwinds. The CEO, Stamatis Tsantanis, really hit the nail on the head with this quote. He points to a low order book against a rapidly aging fleet, strong iron ore export growth, and resilient coal and bauxite volumes. In plain English, the global demand to move heavy commodities is surging, but the supply of available, modern ships to move them is severely restricted. And a supply-demand imbalance like that is a surefire recipe for very strong charter rates. And hey, this isn't just some theoretical pie-in-the-sky future. They are already cashing in right now. Looking ahead to Q3 2026, Seanergy has locked in roughly 71% of their available fleet days at a highly profitable estimated TCE rate of about $31,000 per day. This gives us incredible forward earnings visibility, proving that the strong rates we saw in Q2 are carrying forward with serious momentum.
So when you take a step back and look at the whole shebang, the record $26.2 million quarterly profits, the perfectly financed $591 million fleet expansion, and those massive macro tailwinds, it leaves us with one incredibly compelling question. With a modernized fleet and secured capital, is Seanergy Maritime uniquely positioned to ride the crest of the next major shipping supercycle? Honestly, it certainly looks like they've built a ship strong enough for the journey. Thank you so much for joining me for this explainer, and I hope this helped you make sense of these fantastic financial results.